and welcome to this Wednesday's edition of the India Development Debate. I'm Nayantara in New Delhi. Our top story this evening, the markets and the disruptor in 2020, coronavirus. As we speak, we're seeing an absolute carnage on Wall Street. Crude prices are also tumbling. If you look at the Dow, it has cracked more than 1,000 points in trade. The S&P 500 as well as the Nasdaq plunged more than 3% apiece. When you come to the commodity markets and crude in particular, what you're seeing is a price war between Saudi Arabia and the OPEC group of countries. And the culprit of that is you've got Brent now trading around $35 a barrel. You've got NYMEX crude trading even below that level. Saudi Aramco today, in fact, laid out the fine print of boosting output, saying it's going to be producing an extra 1 million barrels of oil every day. These are the instructions from the Saudi Arabian government. Talking about coronavirus, governments as well as central banks around the world are boosting measures. United Kingdom, where the new Chancellor presented the budget, has come out with a spending plan of $39 billion. You have the Bank of England coming out with an emergency rate cut, 50 basis point rate cut following the Federal Reserve's emergency rate cut. So in Bank of England now, the rate is 0.25%. President Donald Trump has signed an $8.3 billion emergency spend. The U.S. Treasury Secretary says they are in touch with the IMF, the World Bank, the regulators around the world to further come out with steps as and when needed. German Chancellor Angela Merkel has come up with a very strong warning, saying nearly 70% of Germany's population could contract the coronavirus. Clearly, the coronavirus is the biggest disruptor we've had in 2020. You add the price war to that heady combination, and what you've got is a very volatile globe when it comes to the equity markets and the commodity markets. I'm now going to be joined to talk more about this by Manish Singh, Chief Investment Officer at Crosspitch Capital. Also, Bart Merkel, the Global Head of Commodity Strategy at TD Securities. Gentlemen, thank you so much for joining us this evening on the India Development Debate. This is Nayantara in New Delhi. Manish, let me come to you first. It's almost as if investors have nowhere to hide. They're running for cover. Is it now pretty much a given? Would you say we are in the midst of a bear market? Goldman Sachs today has already come out, and its chief equity strategist has come out and is talking about it being the end of a bull run.
Well, in a way, it is end of the bull run for the short term, because if you have 20% correction, you just say you are in the correction territory. Now, there will likely be at least 1 quarter of negative GDP growth. Whether it will be 2 quarters to classify that as a recession, I don't know, and I think it's very difficult to predict. What you saw in UK today was a coordinated monetary and fiscal response. What you're likely to get in Europe tomorrow from ECB, and then either tomorrow or Friday, is also going to be both monetary and fiscal response, because they are going to suspend some of the fiscal targets. Merkel has already indicated that. And in US, they're getting ready to do fiscal response as well. So it's not very easy to say that there will be a recession, because you have to have 2 quarters of negative growth. But you're going to have a very, very shallow and very, very low growth in the US, and possibly 2 quarters negative growth in the Eurozone, because Eurozone was already on the brink of recession. And you will have very low growth in the UK, though the Chancellor in his forecast today at the budget did indicate that we will still have a positive growth. So let's see. But I think there will be a period of where the growth is going to be small, which means your equities are not going to benefit a lot, and we'll be lucky to just stay at the same level, if not go down more.
Okay, and if I could come to Bart now. Hi, Bart. Good evening. You got a price war on. It's pretty clear that maybe the victim of that price war is supposed to be the U.S. energy companies. You've had the President Donald Trump boast to the world how the U.S. doesn't need the Middle East anymore and all of that, and is producing enough energy. But whichever way you look at it, you've got the Brent now trading around $35 a barrel. You've got the NYMEX crude currently at $33 a barrel. It's great for maybe a country like India, but when you look at the metrics of global growth and low oil prices, it's not always very favorable.
No, in fact, the rout in oil prices over the weekend have seriously signaled to the rest of the world and equity markets in particular that this is very much a risk-off market and that we are headed, for some sort of turbulence. Prices at these levels in the 30s for Brent and WTI crude essentially mean that U.S. and North American companies, broadly speaking, are in significant amount of trouble. They will receive prices that are significantly below their cost of production, and many of the higher leverage names will have problems paying their debt if this continues for the time being. Certainly, our impression here is that demand is going to weaken. Whether we get into a formal recession defined as 2 negative quarterly GDP growth or not in North America and globally, we're not sure, but I'm not sure it makes any difference for the oil market. The oil market is being hit on two fronts. On the demand side, just as early as recently as this morning, OPEC and the Energy Information Agency all have declined their projections for demand. TD Securities has also, on our side, we decreased our estimates. We now think that there will be less demand in 2020 than there was in 2019. So things were bad as they were. But now, given the fact that you will see more production from Saudi Arabia, likely more production from other members of the OPEC Plus, the surpluses are going to be quite enormous. And we still think there is a considerable downside risk to prices. We could see a $20 price. We wouldn't be surprised if Saudi Arabia is true to what they were saying this morning and they are lifting supply even more than they promised. This could be a very big problem for the market. And it could very well be that is exactly what Russia was thinking when they didn't come to a deal. This would be very good for them long term if they eliminated the confidence in the U.S. shale business.
You're talking about a $20 oil price. So let me go back to Manish Singh also about this. Manish Singh, you're talking about the end of a bull run. You've got Bart Malik at TD Securities talking about a $20 oil price. I've just talked about what Goldman Sachs has had to say about end of a bull run. You've got coronavirus, the biggest disruptor. We don't know what's going to happen to global growth. You're getting earnings being flagged off, coming down by almost every major corporation in the world. So is gold going to stay as a safe haven? Is it going to be the year of gold as the asset class?
Quite possibly the trade for, when you think in terms of everything is coming to an end, or it's one of those ultimate trades where you don't believe in monetary policy, you don't believe in the power of the government to stave things from happening. I'm not so gloomy on that. My view is that you're going to see more and more fiscal response, which is going to stave off a recession. At least they will try to. Whether it becomes a recession or not, we will have to see. The stresses are in the high-yield credit market, especially in the U.S., and those need to be addressed because there has been a lot of borrowing in those sectors. So if some of these high-yield companies, they go under, and of course, a $20 oil is dire consequences for a lot of them. That could lead to increase in unemployment, and that could lead to even more lower growth, and it could tip U.S. into a recession. It's still not my view that U.S. is going to go into a recession. It'll totally depend on the response that you get, if it's adequate from the U.S. Fiscal policy. So let's see. For now, my thinking is that possibly equities are going to stay here or go slightly lower, if not a lot lower. I don't believe in a lot lower. I think there'll be a lot of response to it, but I do not see an immediate upside you're going to get. Unless you have seen this whole thing play out and you have seen the peak in coronavirus number in the U.S., which you haven't seen yet because they could still have more cases and growing number of cases. So unless you see that, you're not going to see response. But the monetary stimulus is going to stay for long term. So when you see a turnaround in the story, then you will have those animal spirits of buying assets comes back in, and you will still have stimulatory monetary policy. So you could have another leg of the cycle. So I'm just saying that, for a moment I don't see much upside, but too difficult to say anything 2 quarters out.
The Dow is now down over 1,100 points. Manish, my question to you then is, is this a market that is just waiting for some kind of a fiscal stimulus? We've had the monetary stimulus. It's unimpressed most stakeholders on Wall Street, and as central banks around the world look at this, is this the markets pretty much demanding that the President of the United States has to come back with a fiscal policy booster shot? That's the only thing that's going to work. Whatever he's had to say about tax breaks so far has not gone down well either.
I absolutely entirely agree, because I don't think tax break is the right response to it, because a lot of these taxes probably is going to get saved. You really have to give money to people who are going to spend, and that will come from government spending. That will be coming from targeted help to people on the lower end of the earning scheme, or people who are on a gig economy and other things. So there has to be targeted response. If you just give tax cuts, then most of these tax cuts are going to benefit the people who already have means. They are going to just save it. So tax cut clearly is not the right policy to do, and market is going to demand more of that, and therefore you are seeing the sell-off numbers again in the Dow. I can see on my screen, as you say, is 1,000 point. Everyone is looking for fiscal response, because that is the only way you can get growth back, and you can help the people who need help to get the consumption higher, because you're going to have bad numbers on consumption. So it's not as much about supply shock, because even the supply shock was there or is there from China that is coming back on track.
Manish, in the absence right now of a fiscal stimulus measure, which the markets are pretty much demanding around the world, and we're incidentally being joined by Nilesh Shah from Kotak as well. The question I want to ask you, and I'm sure Nilesh wants to hear this too, what is it going to mean for allocations to emerging markets? And you've got a situation of what's happening on Wall Street. Look what's happening across the European markets. Look at Japan and all of that. Cash is king. Everyone's going to be sitting on their reserves. And therefore, is it bad news for emerging markets? Will India stop being the darling as well for most fund managers around the world?
That, everyone will look at their home allocation, and, of course, you take into account the currency view as well. So yes, the emerging market will see less flow, if not some money leaving if things were to go worse. So India will have to rely on its own investors, or its own domestically focused investor who have no other opportunity but to invest in Indian stocks. But again, if you look at if oil goes to $20, I'm not of the opinion oil goes $20. I think it's going to stabilize in $30 range. But even that's a big fiscal boost to India. But everything will come from Indian growth story. For foreign investors, I think, at least that's my opinion, is that, you will see people being very careful where they allocate, and they want to be allocated in the market that they have full understanding of what the policies are going to be. I mean, the 81 bond for Yes Bank has been a bad taste for many people, and that doesn't give India a very good reputation. So people will bear those things in mind. But for now, you will be cautious. So you will definitely be looking not to stretch yourself in markets where you don't have to be, unless that's your mandate. Then it's different. But if your mandate is a global one, then you will choose probably to be out of those markets. And you are probably, and Nilesh probably will know this as well, you're going to see some of those things show up in the flow numbers as well.
Nilesh, let me come to you now. We saw the data that, came out of Amphi as well. Investors, shrugging off the market volatility. Money kept pouring into the equity mutual funds. According to the latest data that came out, net inflows into equity and equity-linked schemes rose by 37%. That's the highest that we have seen in 11 months. Small caps witnessed the highest inflows. On the other hand, the multi and mid-cap schemes had failed to attract investors. Is that the end of the good run? Do you want to respond to what Manish just had to say as well, saying that you would know better about when it comes to portfolio allocations and inflows into India, or do you disagree with the view there of Crossbridge?
No, in the local market, clearly we are benefiting from the SIP flows. Slowly and steadily, word of mouth publicity has ensured that the SIP flows remain positive. Distributors are tirelessly working to hold back investors. And there was a brief rally in Indian market from somewhere around July 2019 to Jan 20, and that kind of pushed SIP returns into double digits for better performing funds. Now, that flows from SIPs have ensured that the domestic flows have by and large remained pretty strong. Of course, it has volatility, but by and large it has remained quite steady and strong, and which is where we have seen in the middle of Feb till now, when FIIs are on the selling side, domestic investors have been able to absorb a lot of supply. Now, going forward, a lot will depend upon how this coronavirus is contained. Till today, or maybe till some time back, it was a China problem, but now it is a global problem. And in the current scenario, where everyday markets are extremely volatile, it will be reasonable on the part of investors to see how does coronavirus get contained, what are the economic impacts of the same, and thereafter they start taking risk, thereafter they start assuming risk. So we are going to see some volatility in domestic flows. The SIP flows might just continue strong, but the lump sum flows will take its own time depending upon how quickly or how late we handle the coronavirus scare.
I take that point very well, and in fact, numbers are only rising when it comes to India and coronavirus. For example, the Maharashtra Chief Minister today is saying there are 10 cases, active cases in Maharashtra, with 8 of them being in Pune. But Nilesh, the other conversation you'll want to hear, I have a commodity expert Bart with me from TD Securities. He's talking about a $20 possibility per barrel of oil. Bart, if you can just come back in. We had Manish Singh of Crossbridge Capital saying, don't know if $20 is possible, but even if you look at the current price, $30 to $35 on the Brent and the NYMEX, it's going to mean globally the oil and gas majors will have to rework their capex plans. We saw that in 2008. Is this something else that you're expecting in 2020? It will have a huge impact in India. We're a net oil importer, so we'll save on that. But it's going to impact capex cycles. It's going to impact a lot of other massive deals that we've got, which could have an impact on the fisc. We are privatizing one of our state-owned oil companies. You had Reliance Industries that was supposed to sign a mega deal with Saudi Aramco. Is that the expectation that, we're going to see a massive slowdown globally of the giants and their capex cycles?
Well, certainly. I think we will very likely see less investment, particularly in the high-cost marginal resources like many U.S. shale resources are concerned. Certainly facilities in Canada, the Canadian oil sands, will have problems attracting investors. We are already seeing a drought of capital inflows in many of those sectors because of regulatory and environmental and sustainability concerns. This type of volatility in markets makes it so much worse. Not only are you functioning at below the cost of production, but you are also having government agents or official sector people within Russia, Saudi Arabia, making the price more volatile and subject to very large fluctuations. That increases the risk, and frankly, many projects are going to be reevaluated. Ones that have relatively high costs all in over the life cycle will be, I think, shuttered, or the flow simply isn't going to be there. That is a real risk, and potentially that leaves us with higher prices down the road. But in the near and midterm, I think we will see an investment drought.
So an investment drought seems to be the expectation now. And obviously, if you've got crude prices crashing 40%, companies will obviously turn bearish and will want to safeguard what they already have. Nilesh, I'm going to come to you, and I'm going to give you the last question this evening on India development debate. There's so much gloom and doom and all of that. But again, I come back to the Amphi data. And what's your big message to the ET Now viewers? Today, for example, our managing editor, Nikunj Dalmia, said, when you look at the markets, you can look at it as short-term gratification that a pizza might give you, or you could look at a dal makhani, which takes a long time, and it's not instant gratification. So having said that, what's the one big message that you have to the viewers of India Development Debate while you're seeing this rout in the equity markets? How should they continue to look at their personal finance? How should they continue to look at mutual funds and SIPs?
So what they have to do does not change because of the event. Be a regular investor, be a long-term investor, be a disciplined asset allocator. They should learn from the experiences of SARS in Jan to March 2003. In those days also there were fears about SARS and global economy getting impacted. Our markets indeed corrected about 13% in Jan to March 2003, but thereafter it went up by about 83%. When you are in a crisis, it looks like it's the end of the world, but slowly and steadily governments, markets do recover, and thereafter they deliver fantastic return. Whether it's SARS, whether it's Zika, whether it's Ebola, whether it's influenza, all those things have created a panic moment for the market. But over a period of time, medical sciences overcome those challenges. Central banks cut interest rates and provide liquidity. Government follow loose fiscal policy. And combination of that pushes economy on the recovery path. Market starts discounting that early, and this cycle continues. So be a patient investor. Hopefully, this crisis also will pass.
Hopefully, this crisis will also pass. And that's a big message coming from Nilesh. And continue doing what you do. It's much easier saying it, Nilesh, but obviously people are very scared about their money, about their savings. Look at what's happening, globally at the markets. But thanks a lot for joining us this evening on the India Development Debate. And folks, with that, we're completely out of time. My thanks for watching.